we still anticipate the monetary metals will have a vertical phase. And you remember the monetary metals took off back in March. We said they're going to accelerate up out of this 3-year wide range. And at that point, silver was trading between $25 and $26. And gold was just above 2,000 yet again. It had been above it a couple times before. But this time it's different, we said. We're going to take off. And they did take off. I mean, gold's no longer 2,000. It's 2650 area, trading right now as we speak on the front month contract. And silver's trading 3160. Back then it was 25.26. And it's actually up more on the year, marginally right now, because the S&P's gained some of the last, since the election, and NASDAQ has, and gold and silver have cooled off. But they're still actually up year to date more than the S&P and the NASDAQ, which nobody realizes. They think it's, they got to be beaten, but they're not.
Gold and silver have had a strong year, with both metals breaking out of a 3-year range earlier this year. Silver traded at $25 and $26 in March, and gold was just above $2,000. Since then, gold has surged to around $2,650, and silver has climbed to $31.60, outperforming the S&P 500 and NASDAQ year-to-date, even as they've cooled off recently. This performance highlights their strength despite the market focus on equities. Michael Oliver, a respected financial analyst and the founder of Momentum Structural Analysis, MSA, explains after the election, stocks surged while gold and silver initially dropped. However, monetary metals have since rebounded, trading above their post-election levels. Historically, when the stock market weakens, capital flows into alternatives like gold, bonds, or silver. Recent T-bond buying suggests nervousness among asset managers. If stocks show any weakness, gold and silver could see significant gains in the next quarter, continuing their upward trend. Speaker Michael Oliver exposes that between 2020 and early 2024, gold and silver moved within a range, with silver showing a staircase-like decline. Now, both metals are trending upward despite pullbacks, gold more steadily and silver more erratically. Silver sees sharper corrections but also more significant gains compared to gold. The trend is positive, and further acceleration is expected as funds start flowing out of overvalued stock markets like the S&P 500 and NASDAQ 100. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
If you bought the news, S&P, NASDAQ, like November the 6th, the day after the election, you had a massive upsurge. And November 5th and 6th, The 2 days right after, you had this massive gap up type surge. And the metals, monetary metals, did quite the opposite. They collapsed. Silver and gold are trading now back above the price level they were when people sold the news. So if you sold the news of the election, Trump's going to defeat inflation, all this, you're losing right now. Silver and gold are actually back above those levels. S&P and NASDAQ are above the levels where if you bought the news, you're still making some money. Not a lot, but you're making some money. But it's interesting, the monetary metals have regained that loss and are trading higher than they were post the election. I think what's restraining, we still anticipate the monetary metals will have a vertical phase. And you remember the monetary metals took off back in March. We beat the table. We said they're going to accelerate up out of this 3-year wide range. And at that point, silver was trading between $25 and $26. And gold was just above 2,000 yet again. It had been above it a couple times before. But this time it's different, we said. We're going to take off. And they did take off. I mean, gold's no longer 2,000. It's 2650 area, trading right now as we speak on the front month contract. And silver's trading 3160. Back then it was 25.26. And it's actually up more on the year, marginally right now, because the S&P's gained some of the last, since the election, and NASDAQ has, and gold and silver have cooled off. But they're still actually up year to date more than the S&P and the NASDAQ, which nobody realizes. They think it's, they got to be beaten, but they're not. They're actually up more than the S&P and the NASDAQ. And we suspect the key ingredient now to engage the silver and gold into a stronger upside is to break the stock market. I don't mean you have to crash it. Start to get the blood flow out of the stock market. Where the assets start to get nervous, they move elsewhere. And there's no time in history where when the stock market collapses, everything else goes down too. There's always some other place they go. And history has told us, 2007 through 2011, gold went up with a break in 2008, but basically rose while the stock market went down. Same as the dot-com tops. Gold went up during that time. So did T-bonds. It was contra. It was a place to go. And if you'll notice in the recent 2 weeks, the T-bonds, they turned up sharply. So somebody's buying T-bonds now. And it's not related at all to the Fed, because if you look when the Fed cut rates in September, T-bond prices went down, yields went up. So it didn't matter what the Fed did, the short end. But suddenly for the last 2 weeks, some asset managers have been buying T-bonds. Why? Are they nervous? If we see any wobble in the stock market, I think you're going to see the monetary metals gain from that blood flow. And the next quarter could be very dramatic. Remember, between 2020 and 2020, early 24, you had this up, down in gold in a range. And you had silver in the staircase to the downside, overlapping. It would go down and go halfway back up, et cetera, et cetera. That tone has totally changed. Now it's all upside, but with pullbacks. So for silver, it's like 3 steps up, 2 steps back. For gold, it's like 1 step up or 2 steps up, 1 step back. Silver's always more erratic, okay. It gets punished more in the pullbacks than gold does, and then on the upside, it gains more. But even that type of behavior, which is different from the prior 3 years, it's a positive direction at least, even despite the pullbacks. I think it's going to accelerate to where you go up 5 steps and then pull back 1, not 2 steps, okay? And I think that tonal change will occur once asset flows start to leave the stock market bubble. And therefore, our focus right now is primarily on the S&P and the NASDAQ 100.
Michael Oliver points out that the financial sector ETF, XLF, which includes banks, asset managers, and insurers, is underperforming despite gains in the S&P 500 and NASDAQ, with XLF nearing critical support levels. Tech, led by NVIDIA's rebound, is driving market strength, but other sectors like commercial real estate, RWR, remain vulnerable. Rising T-bond prices and persistent commercial debt issues highlight underlying market risks that could have significant implications moving forward. The U.S. stock market is in its largest bubble in history, fueled by years of near-zero interest rates and unprecedented monetary expansion since 2009. While hopes for reforms under leaders like Trump, Musk, or Ramaswamy are high, systemic change will face delays and resistance. The bubble's eventual burst will expose economic errors at all levels: households, businesses, and governments. Even a minor correction could trigger a market breakdown, and as panic sets in, the Fed may revert to monetary expansion, benefiting gold and silver significantly. Now let's dive into the interview.
In our last weekend report, we updated XLF, which includes bank stocks and also asset managers and insurance companies. And so it's the financial ETF, broad financial sector. And it's getting hit this week. Now, NASDAQ's up, S&P's up, the financials are down, and frankly, they're trading right now with a couple hours to go in the week below their a level that we didn't want. If you close below it, it isn't a good sign, okay? So despite the chest beating by certain narrow sectors within the market, particularly tech this time, NVIDIA's popped back up again, not to its highs. It's still well off its high it recently made. But you've had enough of a bounce to where NASDAQ is leading the charge this week. But look at the other sectors. Look at commercial real estate, RWR. It's a very vulnerable sector financially. Look at XLF. Why are they down? Why are T-bonds up? Anyway, you got to watch these things because these are the factors that ultimately will play in an enormous way. The debt problem is not going to go away. I'm talking the commercial debt primarily here. It's the headline chasing bubble. And I know there's a lot of positive assumptions about what Trump might do or can do, but or might like to do, we'll put it that way. And the people, some of the people around him, not all. Okay, you scrutinize down the list of some of his appointees, you don't quite get this total free market thing or total change view. And now with Elon Musk and Vivek Ramaswamy, that's different. They're headed in the right direction. The problem is they can't simply dismantle this stuff. They can't just pull a plug and say, okay, it's over. They have to go to Congress to get approval on a lot of these things. It's going to be delayed. It's going to be fought. It's not going to be so easy as they think. And there's the other problem, and the problem would have existed no matter who got elected. We have a stock market bubble. It is the biggest stock market bubble in U.S. history. It's been going on since the 2009 low. And if you look at a money supply chart, you'll see why. Greater monetary growth in the last 10, 15 years than any other prior 10 or 15 years. And Fed funds rates during 10 of those 15 years have been at zero. So, they've been giving money away. So no wonder the market got fueled into a bubble. That bubble will break because it's created errors, embedded economic errors, micro errors by individuals, families, companies, macro errors by governments, etc. And when these errors get ripped open and exposed, they don't go away. And usually that occurs once the stock market breaks its technicals. And we're saying right now, the technicals for massive breakage in the stock market, and all you got to do is the rest of this quarter, then the remaining 3 weeks, is to see a minor wobble, and we're with the nooses around the neck. And it's at that point, then suddenly all the data metrics that the Fed likes to hang their hat on, they'll panic. And therefore go what? Monetary expansion, all the panic methods they use. And that will benefit primarily what? The monetary metals.
Gold and silver have demonstrated resilience and strength amid broader market volatility, outperforming equities year to date and positioning themselves as critical hedges against economic uncertainty. As systemic risks in the stock market grow, coupled with vulnerabilities in sectors like finance and real estate, monetary metals may see accelerated gains. Investors should remain vigilant as these dynamics unfold. How might a significant correction in the stock market impact the demand for gold and silver in the coming months? What strategies can investors adopt to benefit from potential market shifts toward monetary metals? We value your thoughts, so please share them in the comments. If you found this content valuable, please give it a thumbs up and remember to subscribe to stay informed. Thank you for being part of this journey with us.